more minutes while people get going on or get logged on, but just wanted to tell everybody this is going to be informal. Please feel free to speak up and ask questions or add in as we go. I want this to be a useful session for you that's going to help you understand the basic finances a little bit better. And anything I can do to help, just please speak up. Is it a deal? Give me a thumbs up if it's a deal. And I got 4 thumbs up. There we go. Are starting to come in.
We're what? Oh, okay, we'll mute us.
Just unmute when you have a question. So. Okay, I guess we'll go ahead and get rolling. Thank everybody for joining in this evening. My name's Alex White, but everybody's been calling me Doc White for the last 4 or 5 years. I guess that means I'm officially old. But what I'd like to do tonight is just talk to you a little bit about the basics of the financial aspects for the Southern Regional Dairy Challenge so that you're not too confused or intimidated when they hand you the financial statements. And I want to give you some tips on how to make the financial judges, the ag lender or actually the farmer is going to be real interested in this so that you can talk to them, make them happy during your presentations. So can everybody see my home screen there, the Finance Boot Camp PowerPoint? We got it. All right. So, and then I sent the coaches 3 files, this PowerPoint. I also sent them a spreadsheet and then another Word file that has some of the formulas and more information about the ratios. So make sure you get a look at that or take that with you down to Charlotte. Hopefully it'll come in handy for you. So let's get rolling here if I can find my cursor. So here we go. What's the goals for this evening? Want to talk to you about the basic financial statements you're going to see, and that's going to be the balance sheet and the income statement so that you know what they are, what they mean, how you use them as a farm manager or as a ag lender. Want to go through the 5 or 6 main ratios that the ag lender on the panel is going to want to talk about. And these will help you make your decisions about which recommendations you need to focus on for your presentation. So we'll talk about how you calculate them, what they mean, what the benchmarks are, and then look at some ratings as whether it's, I like to use red, yellow, or green, but you can use strong, average, or poor. And then if we have time, and I doubt we will, but if you want, we can talk a little bit about partial budgets, which is a great way of looking at the financial impact of the recommendations you're going to make to the panel. So if we get there, we do great. If we don't, we'll we'll do it later. So again, please feel free to ask questions as we go. Just unmute yourself and speak up, or if you put something in the chat box, I'll try and take care of it that way as well. Or Heather or Lauren or somebody, if you see something in the chat box, let me know and I will we'll address it. Okay, so for the financial analysis of your case farm down in Charlotte, what you're going to get is 2 years of balance sheets, 2 years of income statements that match up to the balance sheets. And other terms for the income statement are Schedule F, that refers to the Schedule F tax form, or a profit and loss, or sometimes people get in a hurry and just call it the P&L. So what you'll find out in finance, we try to make it sound a whole lot more difficult than it is. So we give 3 or 4 names for the same concept. So don't get lost in that language. So when we talk about an income statement, the Schedule F, and a P&L, it's all talking pretty much about the same thing. You're going to need a calculator or a spreadsheet. I would very strongly recommend a spreadsheet. You need some common sense. Just realize that some numbers make sense if they're bigger, or they're better if they're bigger. Some are better if they're smaller. And then a list of the financial benchmarks. And you can get those from the Dairy Challenge website. Go to dairychallenge.org. Look for the resources for students or resources for student preparation. And you'll see about 2/3 of the way down the finance section, you'll see the financial benchmarks. So let's jump into it. Balance sheet is one of the first things I look at when I'm working with a farm from a consulting standpoint. Balance sheet's going to show you the things that you own, your assets. It's going to show you the things that you owe to somebody else. We call those your liabilities. And it's going to show you your net worth, which is how much you as the owner or the owners have invested in the business. And we're looking at one specific day. What you're going to see in the Dairy Challenge, it's probably going to be either December 31st or January 1st of the year. So what this is looking at is what you own and then how you're paying for those things. So what you own, we call your assets. The main ones are going to be cows, your land and buildings, your feed storage facilities, and so on. Your machinery, the cash that you have on hand. Accounts receivable is basically going to be your milk check that you're expecting, and then your feed and supplies. As far as how you pay for these things, okay, so the assets are the things you own. The way you pay for them, there's two main ways, okay? Your money, we call net worth. And again, in finance, we like to use different terms. So net worth, equity, owner contribution, or retained earnings, all kind of refer to the same principles there. I will try to just stick with net worth and equity here this evening. And then we can use somebody else's money to purchase these equipment or these assets. And other people's money are the loans that we're getting. So we're going to refer to these as loans or liabilities or debt in most cases. So here's what your balance sheet is going to look like. It should look very similar to this. So it's going to show you the balance sheet using the fair market value. That says that's what the value of these assets are if we were to sell them and get a fair price for them. And it's going to have two different years. It's going to have December 31st of the first year and December 31st for the second year. At least that's what we think we're going to get. And then we can just look at this. The top, basically 2/3 of this statement are your assets. And we're going to break that into current, intermediate, and long-term assets. I'll talk about what those are. The bottom third there, most of the bottom third are the liabilities, and these are broken into current and non-current liabilities. And then the very bottom line on the balance sheet is your net worth. This is the money that you or you and your family, you and your partners have invested in the business. So that's what she's going to look like. Let's go through them real quick, section by section. The top portion of the balance sheet is the current assets. And a current asset is something that is going to be used up or turned to cash, basically sold within the next 12 months. So within the next year. The main ones that I sort of focus on are cash and savings. You'll see that's up there at the top. The reason I look at that is it helps me see if they have money available to buy new equipment or more cows, or if there's money available to make a down payment. If your recommendation to them is they need to put up a new parlor or buy a new piece of equipment, this helps me see if they have the cash on hand to make those payments. The next section there is next item is accounts receivable. This is money that's owed to you, and you're going to be collecting within the next year, normally within the next 30 to 60 days. So on dairy farms, this is pretty much the value of the milk that they've shipped, but they haven't been paid for yet. So they're going to get that milk check within the next 2 weeks or the next month, depending on how they're paid. Next big thing I look at is your feed inventories. And on the balance sheet, you're going to see homegrown feed inventory and purchased feed. So your homegrown feed inventory is the corn silage, the hay, or whatever else they happen to be producing themselves. The purchased feed inventory is going to be all their concentrates, or if they're buying their feeds, all that will be listed in that dollar amount there. The investment in growing crops is how much money they have basically invested into seed, fertilizer, and pesticides and fuel for the crops that are currently in the field. They haven't been harvested yet. We got your supplies inventory. Prepaid expenses would be primarily going to be your insurances and your rents. Think about your auto insurance. You pay your auto insurance premium at the first of the month. Well, that covers you for the upcoming month. So that's called a prepaid expense. Rent's the same thing. If they're renting a field, renting a pasture, they're going to pay up front, pay the landlord up front, and that gives them the right to use that field for the upcoming year. And then we have items held for sale. That's going to be your livestock that's held for sale, and your crops that they're holding for sale. So what we're doing is listing those assets and the dollar amount that we have on hand as of December 31st of these 2 years. And all they do is walk around and count up how many bales they have, estimate how many tons of feed they have, put a market value on it, and that's where those numbers are coming from. The next section is your intermediate assets. And these are items that are, when you purchase them, you're going to use them to help produce milk or crops. And they usually last for 1 to 10 years in length. So let's just keep it simple. Your intermediate assets are going to be the breeding livestock. We have it broken up just for the dairy. So this is your cows, your bred heifers, your bulls, and probably your younger heifers, the ones that are going to be brought into the herd, your replacements. We have the machinery and equipment, or the equipment and farm vehicles there. And then we have other intermediate assets. This typically is not a very large number for Dairy Challenge, but when you see it, it could be the money they have in a retirement account. It could be the value of the household assets, or it could be something called equity in other entities. This would be the ownership that they have in other companies. And the reason that this might happen in today's world, they might have one company, one LLC that's owning the cows and the equipment. And then they have a separate LLC that's owning the land. And then a third LLC that's the hauling or the transportation company. Well, it's all the same farm. They've just broken it into 3 different sections. This is where the value of those other companies is going to show up on the balance sheet. Okay. And then the last section of the balance sheet, the assets, is going to be your long-term assets. These are the items that are used in production and tend to last more than 10 years. Again, let's just keep this very simple. This is going to be the land, okay, the actually acreage they have, the buildings that they have, the silos, the water tanks or the water systems, the waste management facilities. So your long-term assets are basically land and whatever is attached to the land. And in most cases, we're going to look at these at its fair market value, what the going market value is for these things as of today. All right, any questions on the asset side of a balance sheet? Again, feel free to speak up. And I'm hearing nothing. Okay, so again, put something in the chat box, or just speak up if you do have a question.
Hey Doc, are you seeing that like people that are doing beef on dairy, do they tend to make that more of like a separate LLC, or do they add it to a line item in their dairy balance sheet?
With the good question, Lauren. With beef on dairy, primarily what I'm seeing is they're just lumping everything under the dairy operation. The calves are going to be your crossbred calves. They're going to show up. The steer calves or bull calves are going to go up in here as either dairy livestock held for sale, or they might call them non-dairy livestock held for sale.
Okay.
But I have not seen anybody break out the beef bulls to a separate enterprise. It's typically just listed there with the dairy. Does that make sense?
That makes sense. Thank you.
Okay, great question. There's my first question. Lauren gets a star. All right. Next section of the balance sheet is liabilities. This is other people's money. Okay, this is money you have borrowed from others. And the 4 main sections you're going to see in the current liabilities. And current liabilities are things that you owe as of that day that you're going to be paying back within the next year. So accounts payable, this is going to be how much money you owe your veterinarian or your feed store for services or products that you purchased. You just haven't paid for them yet. The next one in there is your operating loan balance. And your operating loan or operating line of credit, they're basically the same. Okay. This is money that you're borrowing from a lender, and you're going to use this to pay for your operating expenses. This is going to be borrowed money to purchase your feed, or purchase your seed and fertilizer for your crops, or to pay your utility bill or your hired labor. An operating loan is something that you borrow and you're going to pay it back within the year. So an operating loan is a very short-term loan that's going to last for typically not much more than 1 year. If you want to think about an operating loan as a credit card, they operate pretty similar to that. Okay. Accrued interest. Again, this is going to be a relatively small number on most dairies. This is how much interest you owe your lenders as of the day of the balance sheet. So again, every time you make a loan payment, that's going to pay off all of the interest you owe the lender to that date, plus a portion of the loan. We call that the principal. So every time you make a loan payment, you're paying all the interest you owe the lender to date. So accrued interest is how much has built up since you've made your last payment. In most cases, this is going to be a relatively small number. The last section of your current liabilities is the current portion of term debt. Term debt is going to be your longer term liabilities. This is going to be your machinery loans, your livestock loans, and your real estate loans to buy land or put up a new parlor or whatever. What we do in the finance world, just to make life difficult, we try and figure out how much of those loans we're going to be repaying within the next year. And that's called the current portion of term debt. So with these numbers, this is the loan payments, just the principal portion of the loan payments that the farm is going to be making within the next year. Okay, so those are your current liabilities. The next section on here, we call the non-current liabilities. And this is going to be those machinery loans, the livestock loans, and your real estate loans. Your real estate loans we call long-term loans. The machinery loans, breeding livestock loans, they tend to be less than 10 years in length, tend to be probably 3 to 5, 3 to 7 years in length in most cases. So they're called intermediate loans. So if you look on here at this balance sheet, you'll see that their intermediate loans for machinery and livestock were $2 million in the first year, or on December 31st of the first year. And then they actually went up to 2,150,000 in the second year. That means they borrowed more money. So they either bought more cows or they bought more machinery. So we can always go back up here and look, and we see, yep, they have slightly more cows in the dairy herd, possibly with a higher value. And they also have a little bit more in your equipment and farm vehicles. So we can see where, if they have more remaining principal on these intermediate loans, we can go up and look at the intermediate assets and see what changed. What did they purchase? Okay, so there's your liability section. That's the other people's money. And then the very last section of your balance sheet is the your net worth. This is the money that you or the owners of the farm have contributed to the farm over time. Maybe they donated or they contributed land or buildings or machinery or cows, or maybe it's just the money that they used to get the business started. And then when we reinvest back into the company, into the farm, we earn profits during the year, and we use that and we buy more cows or we buy more machinery or more land. That's called retained earnings. That's money, the profits that we made and reinvested back into the farm. So you don't really know where this money is coming from. What you're just going to see is a number. In this case, $7.6 million for the first year, 8.0 or almost 8.1 million for the second year. This just says that their equity, their net worth has increased from 1 year to the next. And normally that's a good sign. We'll want to see this number going up over time. So how do you calculate your net worth? Let's just, again, keep it very simple. We're going to take the value of our total assets, which for the first year is $13.4 million. And then we're going to subtract off your total liabilities, which is blanked out on this one. I can't see what it is. And that gives us the $7.6 million. A big thing to note here, that $7.6 million is not cash that's available that they can use to buy more equipment or buy more cows. That's just the total value of the money they have put back into the farm over the lifetime of the farm. Basically, if that number is very large, that's much safer for the farmer, much safer for the agricultural lender. And it kind of says, you know what, they have lots of collateral available if they do want to borrow more funds. So any questions on the balance sheet there? Got your assets is what you own, got your liabilities is other people's money, and then net worth is your money. Okay, so what do I look for when they hand me this balance sheet? The very first thing I look at is my net worth positive and is it increasing? So if we look at the balance sheet for this example, our net worth was positive $7.6 million, and it increased to from 1 year to the next. That means the farm is safer. They've built up more equity, so they have either made profits or the value of their cows and livestock and machinery and land has gone up. So if that number is very small, that means they're in a really tight position. They don't have a whole lot of extra breathing room. It means they've borrowed a lot of money. If it's negative, that means the value of their loans is greater than the value of their assets. And sometimes lenders refer to that as being upside down. Okay, we owe more than we actually own. That's a horrible situation to be in. So the first thing I look at is my net worth. Is it positive and is it increasing? Next thing I look at is the amount of cash they have on hand. So this farm has 60,000 1 year and 85,000 the next. That money is available just to sort of pay the bills. This is how much they have at that point in time. But this is available to cash that's available that they could use to make a down payment or buy more cows. So your down payments, if you're looking to buy more equipment or buy cows or something or other, a typical down payment is about 20% of the purchase price. So if we're going to buy $100,000 worth of cows, $100,000 times 20% says we probably need to come up with about a $20,000 down payment, and that money is going to come in cash. So if I look at my cash and savings, this farm does have enough cash sitting around there to make that down payment if that's one of your recommendations that you're going to give them. Next thing I'll look at is my herd size growing, or is it staying constant, or is it getting smaller? In this case, my breeding livestock for just the dairy is going from 3.13 million to 3.15. It's gone up by $20,000. Now then, you need to sort of ask yourself, does this mean they have more cows? So we can look at Dairy Comp or PC Dart and see what the actual herd size is from 1 year to the next. So do they have more cows? Are they retaining more heifers because they're looking to expand? Or it might just be a case where in the second year, they have the same number of cows, but for whatever reason, they put a higher dollar value on them. They thought they were much more valuable than the first year. So we need to ask why that herd size is changing. But we can look at the PC Dart or the herd summary to see what's the number of cows. Is it actually growing or staying constant? Next thing, because I'm a geek, I'll look at the debt structure just to see how they're paying for what for these assets. And what I'll sort of look at, number one, my accounts payable. Is it getting bigger or is it getting smaller or staying the same? If it's getting bigger, that can be a sign we have some cash flow problems. They had to put off paying the veterinarian for another month because they didn't have the cash available to pay at that point. So that's one warning sign to me. Next, what's happening to my operating loan balance? This one went up by $15,000. That's not a very big change, so I'm not too worried about that. But if this operating loan balance would have doubled or tripled, that's telling me that they're either making a big change in the operation or they're having trouble paying their bills. The milk price is low or milk production is low. And then for the accrued interest, I don't worry about very much. For your current portion of term debt, normally this number is going to get bigger from 1 year to the next. As we pay down those loans, this number actually gets bigger. In this case, it got smaller, which tells me, you know what, they might have paid off one of their loans completely during the year. So I don't get too upset about those numbers, but I do look at them to see how they're paying for these assets. And then I just look for major changes throughout the balance sheet from one year to the next. Did something change by over $100,000? And if we look at this, our homegrown feed inventory went up from 625,000 to 825,000. My first question is why? Do they have more cash, or do they have more crops on hand? Did they have better yields than normal? Were the price per unit, price per bushel or price per ton, did it go up from one year to the next? So I just sort of look for major changes and try and ask those questions. Why did it happen? Why did they get better? Okay, so what questions do you have for a balance sheet? Hearing nothing. A quiet group here tonight. Okay, the next statement we'll talk about here briefly is the income statement. And again, it's called the profit or loss, or Schedule F. It's got three main sections. The top section here is your farm revenues, and this is the money that they're getting from the sale of their products. So on a dairy farm, this is probably going to be 90+% is going to be coming from milk sales. Then we have the calf, cow, and cull sales. Other dairy revenues, maybe they're selling their waste or they're composting it or something like that. And then non-dairy farm revenues, this would be if they had a beef herd, or if they're selling crops, they're raising some extra crops and selling them. That's going to be listed as non-dairy farm revenues. So this is the dollar value that of the money that's they're getting from the sale of their products. The next section is the expenses, and this is broken into two subsections. Dairy specific expenses are the expenses that are related specifically to the dairy. Non-dairy specific are going to include other enterprises they might have. If they have a beef herd, if they are growing crops for sale, maybe they have a sheep operation or whatever. They're all those expenses are going to be listed down here in all other. And then these other expenses in this section are just for the entire farm. So the interest on all their loans, the depreciation on all their equipment and all their livestock and so on, insurances. So you have dairy specific and then non-dairy specific. If we take our total revenues, or what we call gross income, subtract off our total farm expenses, that's going to tell us our profit for the year. So net farm profit or net farm income is a big number we want to look at. One of the first things I will look at on an income statement is that number, those numbers right there. Are they positive, and are they getting bigger over time? So that's a key thing we need to look at. Oh, let's see. Let's not worry about the cash versus accrual. The numbers you're going to get are accrual based, which is extremely accurate. So this is when you're making decisions. Accrual income statements are really the only ones you should be using. But let's not get too deep into the accounting here. Okay, so what do I look for on the income statement? Number one, is that net farm profit greater than zero, and is it getting bigger? Okay, is this farm getting more profitable over time, or is it getting less profitable? And you need to ask yourself why. Okay, why is it getting better? Why is it getting worse? And we can just go through and look for major changes. But the first thing I want to look at is the farm profitable? Are they making money? Next thing I look at, do the milk sales, the milk revenues make sense? So we can look at this and see, hey, they went from $6.8 million to 7.5. Now you got to be asking yourself the question, why did they go up? Did the milk production per cow go up? Did their milk price go up? Did both of those go up? So why is that changing? But it's going up, and that's usually a good sign. But I'll also sort of work backwards and say, you know what? Let's divide this number, the like the 7.5 million, divide that by the total number of cows. And if the number comes up somewhere around $5,000 to $6,000 per cow, That's about right. And so you know their numbers are making sense. So a check figure for you there, take their revenues from milk sales divided by the total number of cows. This is your lactating cows and your dry cows. If you divide that out, it should come up somewhere. Let's throw a range between $4,000 and $6,000 per cow. Next thing I'll look at is my total feed expense. So that's going to be my total purchased feed and my total homegrown feed expenses. The homegrown feed expenses include the seed, the fertilizer, the fuel, the labor, and so on that it takes to grow these crops. So if we add these together and then divide it by your gross income, that's going to give me what percent my feed expense is of my revenues. So for year 2, if we take the 1.9 million of purchased feed, the 1.2 million of homegrown feeds, add them together, it gives me 3.1 million. Divide it by my $8.3 million of gross income up here, that gives me 37%. And normally this number is going to be somewhere between 35 and 50%, but lower is typically a better number here. Another thing we can do is take that 3.1 million, divide it by the total number of hundredweights of milk that are shipped throughout the year, that again, you can get through your PC Dart or Dairy Comp or your milk check numbers. And then this will tell us what our feed expense is per hundredweight of milk. So in this case, it's 7.21, so $7.20 per hundredweight of milk. And then you can compare that to the average for that region. So this is going to vary wildly, whether it's a grazing dairy or it's a confinement dairy, but we can compare that to what the average is for the overall region. Next thing I'm going to look at on the income statement, and at the bottom of your income statement, it's going to see if the farm has any non-farm income. So does somebody have a part-time or a full-time job off the farm? Because that generates cash, and that cash can be used to pay for some of these expenses or to pay some of our loans. And I'll look at owner withdrawals. So total annual owner withdrawals. This might be 0 for your operation when you look at the or when you get the numbers. So don't worry about that. That just means they're paying themselves a salary. But total owner withdrawals is how much money a farm owner is taking out of the business. And this is going to have an impact. If this number is really large, that's pulling money out of the business that could have been used to pay the feed bill or pay the veterinarian or to repay some of the loans. So I sort of look at those just to sort of get an idea of how the farm is doing. Okay, a couple other things we look at I like to look at on the income statement is my cost of production. What is it costing me per hundredweight of milk that's shipped? And for this, I tend to look at it just at the dairy expenses. So I'll take my total dairy specific expenses and just divide it by the total hundredweights of milk that I shipped throughout the year. For year 1, it was $15.92. For year 2, this one dropped to $15.65. You guys tell me, is that a good sign or a bad sign for this farm? Does that mean they're doing better or they're doing worse? Need somebody to speak up. Don't want anybody falling asleep on me.
Worse,
Worse. Why do you say that, Faith?
because they're spending more to make less money.
Spending more. Okay, I see where you're going there. Their total dairy specific expenses went from 6.2 to 6.7. So they spent $500,000 more on the dairy farm or on the dairy expenses. But look at this, they got more milk production by spending that money. So in this case, their cost of production for year 1 was $15.92. It actually decreased. It cost them less to produce money, or cost them less to produce milk in year 2. So actually, this is going to be slightly better. Okay, but Faith, I absolutely love you speaking up. Way to go! You get a star for the day. So this number tells us what it's costing us in the total dairy specific expenses to produce 100 pounds of milk. The lower this number is, the more profit potential there's going to be for this farmer. So what we can do is compare this to their milk price. If this number is lower than their average milk price, they're going to be okay for the upcoming year. Okay, so from a short run standpoint, the next year, they're going to be in good shape. So we look at these two numbers, I look at these two numbers, and then I'll start asking, why did it change? Why did it decrease? In this case, we ended up spending more money, but we got more milk. So the value of that milk or the money we spent got a heck of a lot more milk on a dollar basis. So higher milk production without significant expenses means that we decreased our cost of production. Okay, so your lender, your dairy farmer, when you're presenting, they're really going to want to see these numbers. Another one I like to look at is called my short run break-even milk price. This is similar to the cost of production, but this takes into account a few other things. So we're going to start with those same dairy specific expenses, but you know what? We're selling cows, we're selling calves, we have some other dairy revenues. So if we subtract those two things from their total dairy expenses, this says, you know what, in order for us to break even, to have just enough money to cover our dairy expenses, we need to sell milk and get revenues of just under $5.7 million. So it's my total dairy expenses minus the cow and calf sales, minus the other dairy revenues, gives me 5.6, almost 5.7 million. If I divide that by my 100 weights of milk that's shipped, again, you can get that through PC Dart, Dairy Comp, and so on. This tells me the minimum short run or the minimum price I need to get for milk to be able to cover my costs for the upcoming year. Okay, my variable cost for the upcoming year is $14.59 per 100 weight of milk. I can compare this number to their actual, the gross milk price that they're getting on their dairy from their milk check. And as long as my gross price that I'm getting paid is greater than this break-even price, that means I'm in good shape. Okay, I only need to get 14.59, so $14.59 a 100 weight. If I'm getting paid 18 or 19, or in today's world, 20, 22, $23 per 100 weight, that says I'm in really good shape for the upcoming year. If we want to look over the next 5 to 10 years or longer, then we can look at your long run break-even milk price. And here we're going to take your total farm expenses. This includes all the expenses from the operation, everything. We're going to subtract out all of our non-milk revenues. So cow sales or calf sales, other revenue, other dairy revenues, and those non-dairy revenues. And this says, you know what, after I adjust for all these other revenues, I need to generate $6.6 million of milk revenue. Again, if I divide that by my total 100 weights of milk that I shipped, excuse me, this gives me my long run break-even milk price, and it's going to be higher. So in this case, it's $17.06 per 100 weight. Again, let's compare this to the projected longer term milk price we expect to earn. As long as our expected price is higher than $17.06 per 100 weight, we can pay our bills. We will be profitable over the upcoming years. Okay, any questions on that at all? Whatever business you go into, if you really need to understand what your break-evens are. It tells you this is the minimum price I need to get for whatever goods and or services that I'm providing. Okay, if anybody's going to vet school, we can do the long run break-even price for small animal exams, or for large animal exams, or surgeries, or whatever. So this is a really important number for everyone to understand. No questions, no comments, no nothing? All right, in that case, let's get into the things that really creep everybody else about, or creep them out about the dairy challenge. And this is where we'll look at the main ratios that the ag lender and the farmer are going to want to see in your presentation. So what we need to do is get the financial benchmarks. And again, you can find these at Dairy Challenge under resources for student prep. And And this tells us the main ratios. We're not going to go over all, we don't need to do all of these, but we're going to look at the main ones. It shows the basic calculation for it. And then it has the good, the caution, and the danger, or the red, yellow, and green, or the strong, average, and weak benchmarks that we're going to use so that we can rate the ratios and try and identify some problems with the farm. Okay, so we're going to get that piece of information that is, again, on the Dairy Challenge website. The main areas we look at from financial analysis are liquidity. This is basically a term that says how quickly can you put your hands on cash without having to sell your cows or your land or your equipment. So how quickly can you collect your accounts receivable is a good way to look at that one. Solvency says how much of your farm have you actually paid for? So remember, there's two ways to pay for things, your money and somebody else's money. So solvency is saying, okay, of your total farm assets, how much, what percent have you paid personally? The third one is going to be your repayment ability, and some lenders refer to this as your capacity. And this tells you how able you are to generate cash to make your annual loan payments. Folks, if there's really only one ratio that I'm going to look at, okay, if I had to pick only one, this is probably going to be the one. Okay, so we'll talk about it, what it tells us. And then we've got profitability. Is the farm making money after it pays all of its expenses? So in other words, what you hear people talking about is, what's my bottom line? Okay, did I make money before I have to pay my taxes? And the last section is going to be your financial efficiency. This is just telling you how well you're using your financial resources. Are we controlling your costs? Are you not getting paint happy and buying too many new pieces of equipment? So these ratios are going to point us in a certain direction. So what we're going to do is look at these ratios. We're going to calculate them, compare it to the industry benchmark, and say for year one, it was yellow, for year two, it was green, or it was red and it went to green, or whatever direction. We're going to look for trends over time. Did the ratio get better or did it get worse? This will help us figure out if we have ongoing problems, and it'll help us figure out how to solve them. And then we can look for ways to improve a bad ratio. I'll give you a couple of tips on here, but it's really kind of common sense once you slow down and think about it. So when it comes to these ratios, for any ratio that you see, not just for a Dairy Challenge, but any ratio, it's going to be the numerator divided by the denominator, or because I'm not good with big concepts, it's the top number divided by the bottom number. So how do you interpret these ratios? You say for whatever the ratio happens to be, for you have X dollars of whatever's on top for every X dollars of whatever's on the bottom. So when we're talking about the current ratio, when we deal with current assets divided by current liabilities, $50,000 of current assets divided by $25,000 of current liabilities. This is just an example. It's not from the statements that I showed you, but 50,000 divided by 25,000 equals 2. So a current ratio of 2 very simply says I've got $2 of current assets for every $1 of current liabilities. Okay. When you look at any of these ratios, just keep that in mind. Whatever your result is, that's the number you have for whatever's on the top of the ratio for every $1 of what's on the bottom of the ratio. So let's get into it. I'm going to hit about five or six different ratios here this evening, the main ones you need to see. So the first one's the current ratio. We just showed you that one. It's current assets divided by your current liabilities. When I show you the balance sheet, you're going to see letters next to it. That's going to be the letter next to A divided by the letter, or the number next to the letter A divided by the number next to C. These are going to be on your balance sheet. Okay. So the benchmark here is anything that is less than 0.8 is bad. Okay. It's poor. This tells us we've got a problem. If you think about your car, this is the red warning light flashing on the dashboard saying we've got troubles. Okay. If it's greater than 1.5, that says we're doing really well. We have a lot of current assets available should we have to pay these current liabilities. So again, for this one, higher is better. And then if, say it's, this ratio is 1.5, this is saying for every, or excuse me, we have $1.50 in current assets, what's on top, for every $1 of current liabilities, what's on the bottom. Okay, so if we look at this one, we're going to go to your balance sheet. It's going to be your total current assets. That's the A. We're going to divide that by your total current liabilities, which is the letter, or down here with the letter C. So it's going to be 1.26 million divided by 1.08 gives us a current ratio of 1.2. If we go back to our rating, 1.2 is between these two numbers. So that means it's going to be yellow or average, okay? Or maybe a caution if you want to use that. It's telling us we have $1.20 in liquid assets, current assets, for every $1 of current liabilities. So that's not too bad. It's greater than 1, so we're feeling good about that anyway. If we look at the second year, that would be the 1.5 million divided by the 1 million right there. It increases from 1.2 to 1.6 from year 1 to year 2. And that's a good thing. We got better, we got stronger, we're more liquid. But the question I'm always wanting to know is why? Okay, why did we get better? So if we look at it from year 1 to year 2, our current assets, they went up by almost $300,000. And our current liabilities actually went down. There's relatively small change there. So now then, why did our current assets go up? Okay. And if we go up here and look, you'll see that their cash, it didn't go up by much. I'm not too worried about that. My accounts receivable went up by $100,000. Okay. Somebody tell me, why do you think their accounts receivable might have gone up from one year to the next? This is the interactive portion where somebody speaks up and gets valuable prizes.
Maybe it's a loan. Like maybe they took out a loan.
Maybe they took out a loan. All right, Justin, good input there. And if we go down here on the loan side, we're going to look at the current liabilities, and we can see that their operating loan, actually, it did go up by $15,000. So that could be, maybe we have $15,000 extra up here. Okay, so good. There's one reason this thing got better. Another reason that this accounts receivable may have gone up is that, again, accounts receivable is money that's owed to you. Maybe you've shipped more milk this year or over the last month than you did last year, or maybe milk prices have gone up. So we need to sort of ask, why is this number gone up? Another reason might be, since we're looking here at the end of the year, sometimes a farmer's going to get their milk check and they're not going to deposit it. They're going to hold on to it because when they deposit it, now it's going to be counted against their or their income for taxes for that year. So maybe this number is bigger because they're just doing some sort of a tax move. Okay, but that would be something I'd look at. But what else jumps out at you here? Look at this homegrown feed inventory. It went up by $200,000. Wow, that's a big change. So between these two, that pretty much accounts for this increase in total current assets. Well, why might your feed inventory, your homegrown feed inventory have gone up? Well, maybe crop prices are higher. Maybe hay prices or silage prices are much higher this year than they were last year. Maybe the prices stayed the same, but this year we had a much better harvest. So we're getting more, we have more corn silage in our silo. So that's going to bump this number up. Another thing might be, you know what? Maybe they've increased their homegrown feed inventory because they're looking at expanding. They want to have more cows next year. So maybe this is going along with their goal of getting increasing the size of the herd. Okay, so look for big changes. Don't worry about $15,000 or $20,000 when you're dealing with several $1 million of assets. Look for big numbers, okay? At least 6 digits, at least $100,000 worth of change to see what's going on. Okay, so there's my accounts receivable. There's my homegrown inventory, are 2 reasons that we're seeing a change in this current ratio. And when we look down at our current liabilities, you know what? They didn't change by very much. $80,000. I'm not too worried about that one. I'm going to be asking the questions, what's going on with my accounts receivable and what's going on with my homegrown feed inventory? Why are they so much different? So when you see a big change, first question, why is this happening, and trying to figure that out. Okay. All right. What if this number comes up low? What if we're down in that red zone? If your liquidity isn't good, that means you're probably going to be subject to some cash flow problems. Should something bad happen, you don't have a lot of cash reserves sitting around to get through them. Think about this from a personal standpoint. If you don't have any money in savings and your car breaks down, how do you pay to get your car fixed? Well, you don't have cash, so we need to put it on our credit card, or we need to borrow money, or we need to call mom and dad, or whatever it happens to be. But what if you have 3 or 4 or 5 months worth of living expenses in a savings account? Now, if your car has problems, we can fall in, we can dig into those savings and pay for the car and not have to worry about borrowing money. So if you have more cash on hand, you have more accounts receivable, you have more inventory on hand, that's like your shock absorber. It helps you get through any small financial potholes you might hit. Another problem with low liquidity is you just don't have as much management flexibility. If you don't have cash, you can't take advantage of as many opportunities out there. So low liquidity is going to be, it's going to limit the recommendations you can make. If this farm, when we're analyzing it in Charlotte, if it has low liquidity, boy, we need to get creative. We need to look for cheap fixes rather than big, expensive types of recommendations. Okay. So how do you improve your liquidity? Number one, improve your efficiency. Okay. Try and get more milk per cow without increasing your expenses too much. Try and have good efficiency numbers as far as pounds of milk shipped per full-time equivalent, or your number of workers there. So try and get more efficient. Try and reduce your costs a little bit, reduce your waste, reduce feed waste, and so on. And then we can take that extra profits that we're earning. So if we're more efficient, we should earn more profits. Then we can use that to build our savings account, or we can use it to pay down our operating loan balance or our accounts payable. Either one of those is going to improve our liquidity. Okay. Another thing we can do, I have my Doc White's bird poop principle. It says if you have a lot of unneeded equipment or underused equipment out there, you know what? Let's see if we can sell it and take the proceeds from that and use that to pay down your operating loans or your accounts receivable. Okay. Or excuse me, your accounts payable. So those are some possible methods we have in there. But if you have low liquidity, that's going to give you less options as far as recommendations you can make for the farm, because they simply don't have the cash available. Okay. Questions, comments?
Earlier, you said high liquidity is better to a point. What is that point, and like, why would it not be good?
Okay, excellent question there, Faith. Let's see, where do we have that one in here? Higher is better to a point. Think about this. Well, on the low side, if we don't have much cash, we don't have these current assets, now we're in a bad spot. So that says higher is better. But what if you have a whole lot of cash? What if you had $500,000 or $1 million? Would you want to keep all that in cash? It would be nice to have, but what are your checking and savings accounts earning for you? Okay.
Nothing, because you're not investing, right?
Exactly. Beautiful. Okay. So by having all of that money sitting in a current in a cash account, or it's in feed account, feed inventories, that money is not directly earning for me. And in today's world, what's happening to our money? Inflation is eating away at it. Okay. So if my current ratio, if it gets much above, I don't know, say 5 or maybe 10. So I had $10 of current assets for every $1 current liabilities. I'm very, very safe, but I'm not going to be as profitable because I have all that money just sitting there, not doing anything for me. Okay, does that make sense, Faith?
Yes, thank you.
Good. That's a great question. Thank you very much. All right, so there's liquidity. There's one of our ratios down. Next one, when you look at the benchmarks, you're going to see 3 different ratios for solvency. Folks, you only need to do one, okay? So you don't waste your time doing all 3 of them, just do one of them. And for this one, let's go ahead, and I think the easiest one to understand is the equity to asset ratio, or it might be called percent equity by some lenders. This tells us how much of your total assets, what percent of your total assets you have paid for out of hand, okay? You've paid for yourself. Think about this. Let's go buy a $20,000 car. Let's put $5,000 down payment and borrow the remaining $15,000. Okay, well, that says I have $5,000 of net worth or equity in that car, divided by the total value of the car, which is $20,000. So that says, you know what? I've got an equity to asset ratio or a percent solvency of 25%. Okay. Well, guess what? With this number, higher is better. Higher is safer. So we'd like to see this ratio be greater than 70%. If it's less than 30%, that means you've borrowed an awful lot of money. That means that you don't have, or that you don't have a lot of wiggle room. A lot of your income is already scheduled to going towards these loan payments. So the higher this number, the safer you are as a business, and the better off you're going to look to the ag lender. So how do we interpret this? If our ratio comes out to be 70%, that says I've paid for 70% of my assets, or I've paid 70 cents for every $1 of assets in my farm. So if you're thinking about starting a business, or if the farm in Charlotte's a relatively young or new business, we would expect this number to be relatively low because we had to borrow so much money to get started. So for young or beginning farmers, we'd like to see this number not go below 30%. Okay. So in other words, we need to make at least a 25 to 30% down payment for most of our assets in order to get the farm up and running. So we're going to go to our balance sheet again. And on this one, we're just going to take E, which is your net worth down at the very bottom, and divide it by your total assets, which is line B. So 7.6 million divided by 13.4, 13.5 million gives us a ratio of 57%. Says that I've invested 57 cents for every dollar that I have in my farm or in my business today. Well, our ratio here, our range is between 30 or less than 30 is red, greater than 70 is green. Well, 57 falls in the middle. So again, we're looking at a yellow or an average or a caution as far as our equity to asset ratio. When we look at it for the next year, it increases slightly. It improves from 57 to 59. Folks, you're not going to see big changes in this ratio from one year to the next. This one takes a long time typically to build up. So don't look for it to change by 10 or 15% in 1 year. It just won't do that. But it says, you know what? I've got in year 2, I've paid for almost 60% of my assets out of pocket. That says I should have a good amount of collateral available if you recommend they borrow money to buy new pieces of equipment or expand the herd. Okay, so the higher this number is, the safer they are, the more overall cushion they have. But we need to, and then we can think about using that as collateral if you want to make a recommendation to buy new assets. Okay, so what if this thing is low? This means you borrowed an awful lot of money. It means that more of your cash is already earmarked. It's going to go to these lenders before you can do anything with it. And again, like low liquidity, this gives us less management flexibility. So how do we make this one better? Well, let's improve our profitability. Well, how do you do that? Get more efficient. Watch your cost control. Watch your feed waste. Try and improve your pounds of milk sold per FTE. Try and increase milk production without increasing your expenses too much. Folks, the things you're learning in your classes from a production standpoint, if we can do them more efficiently, that's going to free up extra cash. And then we can use that extra cash again to pay down our total debts or build our savings. So these are some things we can do to improve your solvency. If you can improve the profitability of the business, chances are you're going to improve the solvency along the same lines. Okay, any questions on solvency? If you can hang with me, we've got, I think, 4 more ratios to go. So let's talk about repayment. To me, this one's one of the most important ratios that's out there. We use the debt coverage ratio to figure out if we have good, bad, or average repayment capacity. Folks, this one's going to be the most detailed or the most complicated to calculate, but it's really not that difficult. Okay, so we're going to start with our net farm income from the income statement. We're going to add back in the depreciation and the interest expense. Okay, depreciation is a non-cash expense. That just means depreciation means the value of your assets dropped over time. Well, we didn't actually pay anybody. We didn't have to write a check for that. So because of that, it's not a cash expense. We're going to add that back into our our net farm income. Also, we're going to add back interest expense because we're trying to figure out how much money is available to repay our principal and interest payments. So we're going to add that interest expense back in. Next thing, we're going to add in our non-farm income. If someone on the farm or someone in the family is working off the farm, they're generating cash, we can use that cash to pay back to make our loan payments. So we're going to add that in, but we have to take money out for our living expenses or our owner withdrawal, and we have to pay some income taxes. So we're going to subtract those numbers out as well. So we turn net farm income plus depreciation and interest plus your non-farm income minus family living, or it's called owner withdrawal on the income statement. We're going to subtract off the income taxes, and that gives us our debt repayment capacity. Then we're going to divide that by our total principal and interest payments. So let's see what this thing looks like, or what's our benchmark. Higher is better. The more money we have available to make our loan payments, the better. So we'd like to see it above 150%. If this thing's less than 110%, that says we're going to have trouble paying our lenders back. Okay. So if our ratio happens to be 150%, that says I've generated $1.50 of cash for every $1 of loan payment that I have to make this year. So this ratio just says how much cash should be available for every $1 of loan payment we're making. So when you think about it that way, higher is going to be safer. So when we look at this one, we're going to take line J, which is our net farm profit. We're going to add back in interest and depreciation, so line G and line H. We're going to add in our non-farm income. So down here in the other information, you'll see total non-farm income. In this case, it's 0. Then we're going to subtract off owner withdrawal and income taxes. And you're going to see that those two are listed down here as well. So the total annual owner withdrawal and the estimated income taxes, we're going to subtract them out. We're going to take that total, which in this case for year 1 is $996,000. We're going to divide that by the total annual principal and interest payments we're making on our loans. Well, that number is going to be given to you as well. It's going to be at the bottom of the income statement here, just as information. And you'll see it's $690,000 for that first year. When we do the math, it gives us 144%. That says that they are generating roughly $1.44 that is available after they pay all their expenses, they pay themselves, they pay their income taxes. So they have $1.44 available for every $1 of principal and interest payment. Okay. Higher is safer. In this case, the upper end, we'd like to see this thing above 150%. they're only at 144%. So let's give them a yellow rating. But you know what? They're still in really good shape. So I wouldn't get too worried on this one. You were darn close to that green rating. Okay. If we look at it for the next year, we go through the same calculations. This increases from 144% to 171%. 171% says for every $1 principal and interest I'm paying, I've generated $1.71. So this means there's more of a cushion. They should be able to make their payments a heck of a lot easier. Well, we need to ask the question, why? Why does this thing get better? Well, if we look at their total payments, they decreased a little bit. So that's going to make a little bit of a difference. But the main reason here, if we look at your total net farm profit, it went from $210,000 to $490,000. Well, why did it get so much bigger? Either our revenues went up or our expenses went down. So if we look at our expenses, our revenues, holy cow, they went up by about $600,000. About $700,000. And most of that is because of higher milk sales. Well, why do they have more milk sales? Did they get better yields of milk yields on their cows, or did milk prices go up, or did both happen? Okay, the best of all worlds there. So in this case, we can say the farm's repayment capacity got better because you got the more milk revenues coming in without having too much more in expenses. So when you see a big change, okay, my milk sales went from 6.8 million to 7.5 million. That's a big change. Ask yourself, why? Did I sell more milk, or did my milk price go up, or was it a combination of the two? Okay. So for this one, how do we improve this if it's low? Folks, just Doc White's simple rule of improving any business. I don't care what type of business it is. If you do the following things, you can improve the repayment capacity, improve the profitability. Number one, increase the revenues without increasing the cost too much. Okay. What can we do to increase the quantity of milk we're selling, or the quality of milk, but so we get a higher price without increasing cost too much? And one thing to be thinking about is, in today's world, cow comfort. If we can do the small things like making sure we have good ventilation and have proper access to water and good bedding, if that doesn't cost too much, but when the cows are more comfortable, they give more milk. So can we do something along those lines to increase our milk quality or milk quantity, get a higher price without increasing those costs too much? The next thing we can look at is look at decreasing our expenses without hurting our milk production. So my advice for you here, start with those top 5. What are your 5 largest expenses? And then look at them and see what we can do to change them to try and reduce our costs, but not hurt our production. On a dairy farm, your top expense pretty much is always going to be feed. So what can you do to reduce your feed costs? Well, let's reduce feed spoilage or feed wastage. Let's maybe push the feed up more often to reduce sorting and reduce feed waste for feed refusals from that standpoint. Can we reduce our vet bills by having better cow comfort, by being cleaner in the parlor and in the freestall barns and so on? Can we reduce our labor expense by being more efficient, by not having people standing around for nearly as long doing nothing? So look at those top 5 expenses. What are your 5 largest expenses? See if you can cut those things down without hurting production. And with the dairy challenge, you're going to be making recommendations to the farm to try and improve the farm. If you can try and get more milk or a higher milk price, or we can do something to cut expenses, that's going to go a long way towards improving their profitability. Okay. So if this ratio looks low, let's start focusing on those things right there. Some other things we can do with to improve this ratio is refinance your debts over a longer time frame. Folks, you're just not going to have the information on this farm to be able to make that determination. But just realize stretching your loan payments out over a longer time frame is going to reduce your monthly or your annual payments, making it easier to pay your lenders back. Okay, the trade-off there is you'll pay more interest over the life of the loan. All right. Next thing, let's talk about profitability. Most farmers want to talk about profit, but did I make money or not? And the main measure we use to measure profitability is your rate of return on assets, which we just call ROA for return on assets. We're going to take your net farm income. We're going to add the interest that we paid back into that one. And then we're going to subtract off that owner withdrawal or the management fee. Then we just divide that by the total farm assets. So profitability, keep this one in the back of your brain. We want to be more profitable, which means we want our ROA to be higher. So higher is better. Our benchmarks here, if it's greater than 8%, in my opinion, that's doing really well for a farm. If we're less than 3%, that means we're not keeping pace with inflation. Okay, right now inflation's kicking along around about 8%, but historically it's down closer to 3%. So we'd like to be able to be earning a rate of return that is at least that rate of inflation. So that's a good benchmark for you as well. For this one, when we take do the ratio, say it comes out to be 5%. 5% means that you earned 5 cents worth of profit. Okay, 0.05. So 5 cents of profit for every $1 of assets in your operation. You're thinking that doesn't sound like a whole lot. Well, guess what? In agriculture, because we need so much land, we need so much cows, we need so much equipment, we have an awful big number on the bottom of this ratio. Our total farm assets are really big. So that's why this number tends to be relatively low compared to some other industries out there. So we're going to take our total farm, our net farm profit. We're going to add back in our interest, so line G, subtract off our owner withdrawals down here on line L, and then we're going to divide that by our total assets that comes from the balance sheet. Okay, so that'll be line B on the balance sheet. Gives us 3%. 3% says that we're generated 3 cents of profit for every $1 of assets on the farm. That's right on the line of between yellow and red. So this is a number that we have a problem. This farm is, it's not too bad in our other areas, but when it comes to profitability, we're on the lower side, on the lower end. If we look at this for year 2, it increased from 3 to 5.1. So again, why did it increase? We didn't have too much change in assets when we look at the balance sheet. But when we look at the profitability, our net farm income went up. It more than doubled. And most of that was due to those the higher milk sales. Okay, so we can start to tell a story here that this farm is getting better because it's either producing more milk or higher quality milk, or the overall economy is improved and milk prices have increased. If this is low, it means we're not going to be able to replace our equipment as it wears out. So we need to be able to generate enough money to cover all of the costs, including depreciation. So for a farm to stay in business the long term, we need to be profitable. So how do you increase it? Going to sound like I'm just repeating myself here. What can we do to increase the revenues without increasing expenses too much? What can we do to decrease those top expenses without hurting production? And you know what? Can we get rid of unneeded stuff? Maybe we don't need to own our own combine or hay equipment. Maybe we're better off to pay somebody to custom harvest for us. Okay, so start thinking, how can we reduce those assets that are just sitting around that aren't being used on a regular basis? Okay, I got 2 more ratios here for you. This is a good one to understand. It's relatively easy to understand. It's called your operating expense receipt ratio. This is telling us what it's costing us in operating or variable expenses to generate $1 of revenues. Okay, so we're going to take our total expenses from the income statement, subtract off depreciation and interest, and then we're going to divide that total by our gross revenues or gross income from the farm. For this one, lower is better. The less it costs us per dollar of revenue, that means that we have more money available for other uses. So if it's less than 65%, we're doing really well. We're controlling our costs. If it's greater than 80%, we're going to be running short on money. Okay, because we're going to have to be making loan payments. We have to pay income taxes. We got to pay ourselves. And a lot of times those things aren't included completely in our expenses. So lower is going to be safer. Okay, lower is stronger. And again, this is telling us if our ratio comes out to be 75%, says it's costing us 75 cents in operating expenses to generate $1 of sales. Okay, if it costs us 75 cents to generate $1 of sales, that leaves us 25 cents that goes towards paying our taxes, our family living expense, interest on our expense on our loans, covering our depreciation, making our loan payments of our principal payments on our loans, and so on. So that's not leaving us a whole lot of money. When we look at the income statement, we're going to take our total expenses. We're going to subtract off interest and depreciation. So down here, line G, H, and I. And then we're going to divide that by your total principal and interest payments, which is down here at the very bottom. Well, I'm sorry, we're going to divide that by our gross income, which is up here at the top, the 7.65 million. In this case, our ratio is 85.3%. Well, that's above the 80% cutoff. So this is going to be red. Folks, this is a warning sign to us. This is saying we are spending way too much money to generate our milk sales. We need to find ways to be much more efficient. Okay, so it's costing us 85 cents to generate $1 of revenue. That only leaves us 15 cents for all those other uses of our money. So it it decreased slightly. It improved from year 1 to year 2, but not very much. So we need to look at ways, how can we improve this to make it better? Well, let's go back and look at those top 5 expenses, and let's go back and look at what we can do to increase our revenues. Okay, higher milk production, higher milk price. So this one is a nice warning sign. It comes out to be red for both years. That says we have an issue, and this is going to help you figure out, are they wasting feed? Is there too much in refusals? Is there too much feed spoilage? Do they have too much labor? Do they have too much equipment sitting around, or they're spending a lot of money on repairs for their equipment? This helps you figure out what recommendations to make at the Dairy Challenge. Okay, the last ratio. This one's kind of a fun one. It's just going to take your total sales, your gross income, and divide it by your total assets. It's called the capital asset, the capital turnover ratio. This is telling us how much money we are generating, how much revenue we're generating for every $1 of assets that we have. And just think common sense. I want this number to be bigger. I want to generate as much money as I can from my assets. If I'm not generating much, I've got too much assets just sitting around not doing anything. Okay. And one of my key phrases, idle assets are killers. If you spend $100,000 on a piece of equipment and it sits in the barn and isn't used but a couple of days a year, that's probably a waste of money. We can probably do things a little bit better. So for this one, we're going to look at higher is better. So we'd like to see this above 40%. If it's less than 20%, that's going to give us a red indicator. We have an issue out there. Okay. If it's 40%, it says that for every $1 of assets I have, I'm generating 40 cents worth of gross sales or gross revenues. So when we look at this one, this is on your balance sheet. The gross sales comes from your income statement. The total assets comes from your balance sheet. And for this farm, it comes out to be 57%. Well, guess what? That's really strong for a farm. So they're generating 57 cents of revenue for every $1 of assets they have on the farm. This farm is doing an outstanding job when it comes to their financial efficiency. Okay. Again, if it's poor, how do we improve it? let's look for this bird poop principle. Oh, look for that bird poop principle. Let's walk through the barn and see what equipment's all dirty and rusty and hasn't been used for a while, and just get rid of it. Let's find a way to operate without having that equipment. And then what can we find new uses for the assets? Can we do some custom harvesting for our neighbors? Or can we find another use for it, clearing snow off of parking lots up there in West Virginia? So what can we do with our assets to generate more sales? So to finish up here, for the financial ratios section of your presentation, of your analysis, come up with a table that lists each of these main ratios. I wouldn't do any other ratios. I'd just keep it this simple. Look at the ratios for each year. So show them for both years. Rate it, whether it's red, yellow, or green, or poor, average, or strong, whatever makes the most sense to you. I'm going to recommend color coding it so that when you look at it, you understand it, but the judges are also going to understand what's going on. I'd have a column in there that shows the trend. Is it getting better? Is it staying the same, or is it getting worse? And then if you have room on your slides, I'd show the benchmark. Okay. So maybe it looks something like this. For liquidity, I looked at the current ratio. The benchmarks I used were less than 0.8 or greater than 1.5. In year one, this farm had a current ratio of 1.2. It's not bad, but we'd like to see it a little bit better. It improved from year one to year two to 1.6, saying that they have $1.60 of current assets for every dollar of current liabilities. So the trend is improving. So having a summary table like this is going to make that ag lender and that farmer really smile, because it shows them that you did your homework, you looked at all the main areas, and you understand the basics of what's going on. Okay, so I think one slide with this table and talk through the numbers in a very general manner, you'll be in very good shape. Okay, so when you're looking at these ratios, if you can use these to help build your recommendations. If they have poor liquidity or poor solvency, don't recommend that they buy a lot of new equipment or that they expand, because they don't have the money to make the down payments or to purchase those assets at the moment. So let's go look for simpler, less expensive recommendations. If profitability or repayment ability is poor, try to find cheap ways to improve things on the farm. So again, cow comfort's a really good place to look. Okay, can I just re-aim the fans or make sure the fans are working and they're coming on at the right time? That should get me more milk production. That should increase my revenues, and it didn't really cost me very much at all. So look for something relatively cheap to make your recommendations. And again, if financial efficiency is poor, what can we do to improve? Look at those top 5 expenses that we can cut without hurting your production. Look at the cheap way to produce more milk, and then get rid of that unused or underutilized assets. So once you do all that, just a couple pieces of advice. Number one, don't freak out about the finances. It's not voodoo. It's not some dark science here. It's not really that hard when you take a moment and look at it, but it is really important to every business. I don't care what business we're talking about. To make you feel a little bit more comfortable at the presentation, chances are the ag lender and the farmer are the only ones in the entire room that are going to care about this stuff. So look at them, focus on them, smile at them when you speak, and then use the language of finance or ag lending. Tell them, if you implement our recommendation, this is going to improve your liquidity and help you reach your goal of whatever their goal happens to be. Let's see. So we got that, and that. I think we're good. Folks, what questions do you have for me? What can I do to confuse you even more? Don't be shy. Speak up.
Hey Doc, real quick. So in terms of the income sheet, right?
Right.
As far as like what they've recently gotten, or like the previous year, what they've gotten in terms of income for certain things. So it kind of breaks out things like bedding, insurance, labor, milk marketing, renting, repairs, veterinary medicine, and breeding. Do you recommend using those numbers when you're trying to estimate for a partial budget? Or what do you think is a better route of going and trying to figure out what an average cost would be for making a change or implementing something? Does that make sense?
Yes, if you look at the income statement, hopefully you can see this one on online there or on Zoom. We can look at their bedding expense, and that'll tell us what they're currently spending. If you divide that by a total number of cows, now we can get it on a per cow basis and see if that number makes sense. We can compare that to local averages. Maybe I don't know that you're going to get local averages for all these numbers, but if you do, how do they compare? Are they above or below average? And is that a good or a bad thing? But yes, if you're looking at doing a partial budget, say you want to, I don't know, from a bedding standpoint, we're going to use higher quality bedding. So we're going to go from $50 per cow per year to $90 per cow per year. You can always use the numbers on the income statement as your base, as your initial basis, and then kind of bump it up a little bit depending on your recommendation. From a feed standpoint, you can go through like I showed you and take this, in this case, take your purchase feed and your homegrown feed expenses, add them together. That's basically the total feed expense. And you can divide that by on a per cow basis. You can do it for the per hundredweight of milk. And then use that in your partial budget when you're saying, I'm going to make a change from going from here to here. So yes, this would be a good place to start. I think it's very defendable, so that if the ag lender or the farmer says, where'd you get these numbers? Hey, I used from your records. That's about as accurate as we can get.
Makes sense. Thank you.
Okay, sure. What other questions you have out there? If there aren't any questions, go for it.
I was saying, what other resources would you recommend us looking at to kind of like further our understanding of financial records and like bookkeeping?
Okay, excellent question. If you go to the Dairy Challenge website and look at the resources for student prep, they've got some general information, and then they've got a whole section on finance. There's some videos on there. There's some worksheets on there. There's some examples of how to calculate these things or what the numbers mean. I think that would be an excellent starting point for more information. Other than that, I would contact your local farm credit office and have them talk to you, because they should be able to answer those types of questions or relate them to you in an understandable method. Let's see, what else can we do on there? You can email me and I'll talk with you, or send you some of the videos I use in my classes. If they would be of help, I'm more than happy to share them with you. But I think your first step there is go to the dairychallenge.org website, look at the resources for student preparation, and just kind of flick through those. There is one they just posted on partial budgeting. I can't remember the lady's name. She's with the Farm Credit Association. I think her first name's Kelsey. She did an outstanding presentation. It's about a 40-minute presentation on partial budgeting, and it's fantastic. So I would very strongly recommend looking at that one. But just sort of poke through and see what you can see that's going to help you out. If you still have questions, ask me. Okay. At the Dairy Challenge, there's going to be 3 or 4 roving financial mentors. So just raise your hand and ask questions from there, and we'll try and do our best to explain it and help you think through the ratios or think through your partial budgets. Does that help you?
Yes, thank you so much.
Certainly. Any other questions from anybody? If not, I'm going to turn it around on you. Nobody can leave. Nobody can log off here. until I hear 5 things that you learned from this evening that you thought were helpful or were useful or you never realized before. So again, nobody can live. I need to hear 5 things. Somebody start me off.
Well, this is the second time I've heard you do a presentation on like financial stuff, and a lot more makes sense now. I didn't understand because I was just like, I've never seen any of this stuff before the first time you presented. And so now I understand like how like liquidity and solvency and all that like pertain to the recommendations we're making, and like how much financial freedom they have to make bigger investments, or if the recommendations need to be focused on small things that will help create more money.
Exactly. Okay, but Faith, you're exactly right. This financial stuff, it's like learning a new language. And it's if you pick up the concepts, liquidity, solvency, profitability, what those things mean, and then you just sort of take a step back and think, oh, liquidity, what can I do to have more cash on hand or have more flexibility with the cash that I have? And then think about the recommendations you can make that would help the farmer move towards that goal. So good. I'm glad it's sinking in a little bit. So either that means I did a horrible job the first time you heard me, or I did a better job this time, or it's just hearing it again, it slowly starts to sink into everybody.
You
So
did a
thank you.
great job both times. You did a great, it was definitely me the first time being like, I've never heard any of this and it all feels chaotic. But you did great both times.
Why, thank you. But that's sort of like me listening to somebody talking about nutrition or genetics. Goes right over my head really fast. So I'm not that smart, but if you put a dollar sign in front of a number, I understand it a heck of a lot better. So excellent. Somebody else, give me something you learned, something that helped you out a little bit, something that you can tell me back or about when we get to Charlotte.
I feel like I learned about the liquidity, like in improving liquidity. I feel like that's something new, like that term. I've never really heard of liquidity before, but and liquidity improving liquidity like efficiency in your operation, like even if you have low liquidity, is a key part that I really learned today, which makes sense, started clicking in my head.
Yeah, with liquidity, Justin, just think about your own personal budget. How much money do you have sitting in your checking account and savings account, and how much do you owe somebody over the next year, as far as rent payments, utility payments, or not utility, but loan payments, student loan payments, and so on. The more money you have available, the easier it's going to be to make those payments, the more flexibility you're going to have. So good. The more, and if I don't have much money, that means I need to be really efficient to use the money that I have much more efficiently. So if you don't have a lot of savings, you don't have a lot of income, we need to use a shopping list. We need to stick to it. We need to use coupons, those sorts of things to try and get through the month. So it's the same thing for a farm. So look for what they can do to become more efficient with their feed use, with their labor use, with how they're spending their money. Good. Appreciate it. Anybody else? Speak up for me.
Well, for me, I never took into account that the owner could also put in some of their own money into the company, and you can also count that within the balance sheet or the income of the company. And so, yeah, I just kind of learned that today. So
Good. Yeah. Remember, when you want to buy something, and whatever business, there's 2 ways to buy things. One of them is your own money, and the other one is somebody else's money. And the more of your money you can use, the safer it's going to be for the business and for the lender. And that's going to make it easier for you to borrow more money down the road. Okay. So great. Glad you saw that one. Lauren, Dr. Lauren, did I see your hand up?
No, I was just clapping. I like to hear all the feedback. It's like, oh, I didn't think about that either, but that's true. I didn't know that either.
Excellent. Well, folks, what schools we have represented here this evening? I know I got my West Virginia friends and my where's my Mount Olive folks? They were on. Lauren, you're where now?
North
And-
Carolina A&T State
A&T?
University.
Okay, we're glad to have you closer than you were.
Yeah.
Anybody from Clemson or Tuskegee or NC State or Tuskegee? Yeah, good. Will we see you in Charlotte?
Yes, you will.
Excellent. I look forward to it.
I'm from Tarleton.
Oh, you guys coming up?
Yes, we are.
Sweet. I really enjoyed being down there. That was last year we were down in Tarleton for the Southern Dairy Challenge. That was fantastic. So glad you're coming up. Any
Middle
other-
Tennessee State University.
Tennessee State, excellent. So are you bringing a bunch of folks down to the Dairy Challenge?
We have about 3 people coming.
3, okay, good. So that, let's see, Tennessee State, it's been a few years since you've been to the Dairy Challenge, I think.
Middle Tennessee State University.
Middle Tennessee, okay, gotcha.
Yes, sir.
Okay, gotcha, okay. Well, folks, it's about that time. I need to run over to something else. If you have any questions at all that I can be of help with, okay, let me get my email back up here for you. And at the end of this presentation that I sent to the coaches, it talks you through some of the some deals on partial budgeting. But if you have a question, just email me at docwhite@vt.edu. I will do my best to get back to you or get you hooked up with information that'll answer your questions. So if you don't have any other questions, I look forward to seeing everybody in Charlotte, and travel safe, and we will see you there.